Good morning, good afternoon, good evening, good night, wherever you are joining us from around the world today. I warmly welcome you to the Parliamentary Network's Global Parliamentary Forum session on debt management, transparency and creativity for economic equitable growth. Distinguished ladies and gentlemen, you should know that the forum aims to establish a platform for collective dialogue to look at public policies and best practices, to face current global challenges and promote global action. We parliamentarians play a critical oversight role. This session on debt management provides us, the legislators, an opportunity to discuss with high-level panel members and experts from the World Bank and the IMF and around the globe on how to manage debt in a transparent and equitable manner to better recover from the pandemic while addressing medium and long-term development issues. As you know, before COVID-19 pandemic, debt was already at record high in emerging and developing economies. The pandemic is pushing a growing number of these concerns into debt distress, and already we've heard of some countries defaulting. In case of my own country, Jamaica, my government's mandate is to secure Jamaica's economic independence, or having gained political independence in 1962. Jamaica, for many decades, has remained economically dependent and as a result has lost space to address adequately social problems in the nation. Our need to maintain sustainable and credible economic path for future generation cannot be overstated. But as we start the session, I think it's important that we bring to the forefront the need to maintain sustainable and credible economic path for future generation. When we borrow, we must do so mindful of the long-term sustainability of public debt. In my own case, high levels of national debt has compromised our economic independence and has threatened our ability to sustain ourselves without external assistance. And this has led to overdependence on creditors, loss of flexibility and space in setting economic priorities. And I think this is the primary economic lesson for Jamaica since independence. And so the need to manage debt with transparency and creativity for equitable growth is critical. I'm Marlene Malahoo Fort. I currently serve as one of the vice presidents for Latin America and the Caribbean on the Parliamentary Network Board of Governors. It is my pleasure to welcome Carmen Reinhardt, who really needs no introduction. She is a senior vice president and chief economist with the World Bank Group. Morning, Carmen, welcome.
Thank you for also a wonderful remarks. It's really an honor and a pleasure to be here again, and to be here also with my colleague and co-author and friend, Chayla. And what I would like to make some brief remarks on is three interrelated topics / themes: risk, transparency, and debt management, and the interaction between risk, transparency, and debt management. And so let me start by perhaps stating the obvious to all of you who are well-versed in these topics. Debt transparency is really a much needed input into establishing a strong presence in domestic and international capital markets, in improving credit ratings, in gathering a standing not to mention fostering stability. It is important in normal times, and it is even more important in times of high risk, which is where we find ourselves now. So I will go on and say something about those risks in a moment. Good debt management, like transparency, is a much needed ingredient for all the same reasons in good and bad times. Risky debt management practices can really come back to haunt you. And again, my emphasis is going to be in what some of the do's and don'ts in a period of high risk. On the high risk side, I don't really need to tell this group. I think you're all too painfully aware of how precarious conditions are for emerging markets in general, and for some emerging markets more than others. But you know, as we have just heard, many countries already had high levels of indebtedness, had precarious fiscal situations, had experienced a sustained economic slowdown even before COVID hit. And now it's been over 2 years. So a big source of risk, a big source of concerns is not just the scale of this pandemic, but its duration, its cumulative toll on finances, both public and private. And let me highlight, private is very important. This is one of my messages. Indeed, it's one of the messages that Chela and I reiterated in our joint piece in finance and development. One not only has to care about the health of the public balance sheet, public sector balance sheet, but also the private sector balance sheet, because it is well known that in times of high stress, like what we are living through, the private debts often become public debts as government supports either financial institutions or corporates in distress. So let me just focus on a couple of things to look for in times, especially in times like this. I think on the what to do in terms of the do's, I think moving forward with full disclosure of debts and the terms of the debts is extremely important, because in times of high risk, there's a tendency to throw everyone in the same bag. More transparency, I think, allows for better differentiation for investors, for capital markets, for credit rating agencies. So it's exceptionally critical too. On disclosure, not only of the degree of indebtedness, but in a consolidated way. Very often what we get, at least in the international debt statistics at the bank, is much higher quality and coverage of data for the central government, but then big gaps for state-owned enterprises and special purpose vehicles and the like. So disclosure of the terms is terribly important. For countries that are already in debt distress, it is even more important, because without that kind of clarity, creditor coordination is impaired, and any effort at debt restructuring or debt reprofiling can get significantly delayed. Now, on debt management, and I'm running out of time, so I will say a couple of things. This is not the moment. I mean, governments in times of stress and private firms as well are notorious for what is called gambling for resurrection, in which you treat the current problem as a transitory situation, and therefore take on risks by financing during the period of stress with even more high interest, short maturity debt. That strategy of, well, maybe longer term funding is prohibitively expensive. Maybe it's okay to borrow short and to borrow at high interest rates. Avoid that temptation to the extent possible, because that a recurring feature of financial crisis, whether these are private, public, or a combination of the two, is rollover risk. And in times of, again, a great degree of uncertainty, rising international interest rates, tightening financial conditions, not only higher inflation, but a lot more variability in inflation. Those are the kinds that can really exacerbate rollover risks as the investor community, has in the past, if the past is any guide, shown a tendency to withdraw from risk taking. So this is really the time for very prudent debt management, maturity wise, currency wise, and again, with full disclosure. Let me stop here.
Thank you so much, Carmen. I don't think we can overemphasize the criticality of discipline in managing the debt, and especially, as you say, in times of high risk. We want to take our first poll question at this time. I'm inviting all participants to take the question. Governments increased spending dramatically during the pandemic. Is rising public debt a concern for long-term growth in your country? We know that a lot of economic activities dried up during the pandemic, and in order to meet expenses, governments are borrowing. How much of a concern is this to you? And while the question is being taken, just want to remind all parliamentarians of the importance of asking your executive about the terms of debt, because we are the ones who see the consequences as we meet our constituents face to face when we go out to interact. And we know what it is like when there is an inability to meet genuine expenses. And so that oversight role is extremely important. So governments increase spending dramatically during the pandemic. Is rising public debt a concern for long-term growth in your country? I know certainly for Jamaica, I'll tell you a little about our experience in terms of our debt situation. Classic case for the IMF, classic study worldwide. But at this time, ladies and gentlemen, it is my distinct pleasure to welcome Jela Pazabashulu, Director of Strategy, Policy and Review Department. Jela, welcome to the forum discussion. We look forward to your presentation.
Thank you. Thank you very much, Marlene. And it's really a great pleasure to be here with all of you, and of course with Carmen, who we have been working very closely with. And this is a very important discussion because the parliamentarians, as you said, have a key role to ensure accountability of debt. This oversight role is really critical, and Jamaica is a great success story in many ways, and you have a lot of lessons that that you can usefully share. I want to talk about three issues and basically complement what Carmen said. First, a little bit about where we are. You mentioned, and it was in the survey question, in terms of the conjuncture and why that makes everything much more difficult. What has been done so far and what needs to be done going forward? Global debt already at record high levels prior to the pandemic. Deficits and debt, as was the survey question, accumulated faster than ever, much more than during the Great Depression, much more than the global financial crisis. Actually, the increase in debt and deficits were comparable to the First World War and Second World War periods. And that means we are at 256% of global GDP in terms of debt in 2020, led mainly by advanced economies and China, but of course also many other countries have increased debt as well. That's public debt. Private debt has also reached record levels in many countries. So on top of so we have crisis after crisis. We had the pandemic. We now have the war in Ukraine, which is of course adding new pressures on public financing through direct and indirect linkages. Growth is at risk. We have weaker trade, lower revenues, higher spending in many countries because of all these uncertainties and crises. All that means, of course, is very adverse debt dynamics. And that's the big problem. Debt vulnerabilities are very high and countries are either in debt distress or in risk of debt distress at a time when many countries actually need more debt, because we have the scars from the pandemic that we need to recover from. We have short-term financing needs for that, but we also have substantial financing needs in terms of addressing the challenges of the pandemic, be it on education and other aspects, but also the digitalization and climate change that is happening. So it is really a critical time to have to be able to access good debt. And I underline good. There's good debt, there's bad debt, and there's ugly debt. And the role I think that you play in terms of making sure that the executives are held accountable so that it's good debt, it's debt that actually helps development and growth and sustainable growth, which is the only way that debt becomes sustainable. So what that means is there's a need, of course, to prioritize spending. There's a need to make sure that investments are transparent and that there is an effort to make debt much more transparent. And Carmen mentioned this is really critical. There are three types of transparency in my view. One is among creditors, and that's debt reconciliation. And it's critical, as Carmen said, for debt restructuring to take place and for the creditors to trust each other. There is a second type of transparency, which is to IFIs, international financial institutions or official donors, which is really critical for these institutions like ourselves and the bank to be able to lend. And then the third one is to the public. And the levels of disclosure are not necessarily exactly the same under these three transparencies. In terms of, so that's where we are. We have this big issue, big problem, and I'm just checking. I have 3 more minutes left. Okay, and I want to go into what tools we have. And our tools are limited, especially given some of the complexities that we face in the context of low income and some of the emerging market countries. We have a more complex creditor composition. In the past, most debt of the low income countries was owed to multilateral institutions and advanced economies. Today, we have other creditors. We have China, we have Eurobonds, private sector credit, syndicated loans. So it's a much more complex diverse creditor landscape, which makes debt restructuring more difficult because the processes that have been in place, like the Paris Club and so on, are not as relevant in terms of the share of debt. The share of external debt owed to China is 18% in 2020. It was 2% in 2000. And China, of course, is the largest official bilateral creditor to almost 40 low-income countries. Private bondholders of Eurobonds increased to 11% from 3% during the same period. I'm talking about low-income countries mainly now. So what does this mean? What do we need to do in terms of having more transparency? So what needs to be done? We have been working very hard. Of course, countries themselves, as you have mentioned, have been doing a lot in terms of increasing early warning systems, strengthening debt management capacity, and also outreach between creditors and borrowers on debt issues. We have, as the fund, and I think the World Bank as well, have also reformed our own policies to make sure that we can land in line with much more transparency. But we need to go further. We have to make sure that we have a mechanism for official creditors and other creditors to be able to coordinate. And the G20 came up with the common framework. This was announced last year, and mainly for countries that are the poorer countries, low-income countries. This was to help address the debt problems in these countries, ensure broad participation by creditors with burden sharing. But it has yet to deliver. We have 3 cases that have applied to the common framework with very limited, basically no success so far. So G20 needs to deliver, and that requires consensus among them, and we have been working very hard with them. But then there are other countries which are not part of the G20 common framework, more recently Suriname and Sri Lanka. And this is really important that we also find a mechanism for the official creditors to be able to coordinate and bring in the private sector to be able to resolve the debt problems of these countries. Because otherwise, us as an institution, the IMF, and I don't want to talk for the World Bank, we will not be able to support these countries because of issues of our policies and debt sustainability. So I think we are in very difficult times, very uncertain times, and debt issues needs to be put as priority. And I'm very glad that you have this issue as the key dialogue in this very important forum. Thank you very much, and I look forward to the discussion.
Thank you so much, Jayla. Speaking from Jamaica, where we've had so many problems, what I'm particularly grateful for is a recognition within the IMF, within the World Bank, within the lender institution of the need to get in early and to work with the economies and the governments to ensure that we can recover better and that the lessons learned can be implemented. I see a number of questions have been posted. We will come to them in short order. We now turn to a very distinguished panel of parliamentarians. I think we have Emmanuel Alvarez Adges, founding partner and director of macroeconomics from PXQ Consultancy. We're going to take Emmanuel's contribution and to the discussion. Very difficult, very uncertain times. But if ever there is a need for dialogue around this issue, now it is. If ever there is a time for parliamentarians, given their critical oversight role, to be aware of what is happening and how to hold their governments more accountable in the interest of the people that were elected and appointed to serve, this is it. Emmanuel? Right, while we are awaiting Emmanuel, just to see, I see questions are being asked about debt pardon in poor countries. There is never a period where that issue has not arisen, debt forgiveness. There is also a question about the difference between the developing and the developed countries in managing debt and factors that are increasing inflation. Is Emmanuel with us? All right, so then we will go to our second poll question. And we would welcome your questions again to the panel. And we ask that you submit these questions via the Q&A button at the bottom of the screen. But our second question addresses high public debt. It is now a global issue. In your view, is there a policy that should take precedence over others to mitigate increasing debt levels? And we talk about the fiscal policies, revenue enhancing, expenditure containment measures, monetary policy, other growth enhancing policies to raise the growth rate of GDP, oversight and anti-corruption measures, all of the above. So in this time of heightened crisis, high public debt is now a global issue. In your view, is there a policy that should take precedence over others to mitigate increasing debt levels? Fiscal policy, enhance revenue. What are the implications for that? Do we raise taxes in economies that are already stressed? Do we contain expenditure when there is great need, when the real needs exceed the available resources? What of the monetary policies? What of other growth enhancing policies to raise the growth rate of GDP? What of oversight and anti-corruption measures, just to ensure that monies spent are spent well? As we close off the poll question, we will then invite the Honorable Steve Azeki, Member of Parliament for Nigeria, who will make his contribution to today's discussion. But do submit your answers to poll question number 2. Honorable Steve, I hand over to you.
Thank you very much. Good afternoon, participants, especially my colleagues from around the world, and my high regards to staff of the World Bank and the IMF. Thank you for the opportunity to make my contribution from Nigeria. My name is Steve Azeki from Nigeria, Member of Parliament. Yes, we are looking at activities in our economies. Truly, the pandemic caused global economic meltdown, and most nations are now depending on borrowing. Yes, there is this dichotomy of developed countries and developing countries. We are very much aware of that, even though most nations, even the developed countries, are doing some borrowing and debt management. But the COVID pandemic and the war in Ukraine, the Russian invasion on Ukraine, has also contributed to the meltdown. And people may think that Africa, for instance, is very far from Europe, but we're already feeling the pain and the hardship of the war going on. We're just recovering from the pandemic and now the war. So globally, there is some kind of anxiety and problems. But I would like to pay attention to developing countries, and especially my country, Nigeria. For instance, in Nigeria, we have to know that we have very weak institutions, even our parliament, I cannot say we are on top of it, because the executive still has a lot to say. They still do a lot of dictation, and we vote according on party lines. Most times we set aside national interests. This is true, and I'm sure this is true in most countries too, but in Nigeria, and especially developed countries, executive, that they pay the bills, so they have more powers to manipulate the system and the judiciary. For example, debt services in 2021 consumed as much as 98% of government revenue in Nigeria, leaving a paltry 2% for investment in public services. Our debt body is already constraining growth. Fitch, a rating company, has forecast a reduction in growth of the Nigerian economy from 4.2% projected by the government to just 3%. And it's still lowering itself down there. With no abatements horrifying trend in sight, we may soon like the likelihood of this trend is founded on the astronomically high debt to revenue ratio, which by 2021 statistics stood at 76%. We find it hard to, we cannot at this moment even pay or try to think of generating revenue. So I'm even worried, we are worried in Parliament that a time may come that Nigeria will entirely borrow everything, whatever for capital, for overheads and all that from borrowing, you know. Let me give you an example. Just last week, federal government of Nigeria submitted
I think we are
a raft adjustment to the 2022 national dose increased the best oil to $73. Also requested for a reduction in the projected oil production from 1.88 million barrel per day to 1.6 million barrel per day. Now, let me say this, and this is what some of us in the Parliament are crying and speaking out, but we've not found any hope in it. For instance, even if we are talking ordinarily, by now Nigeria is supposed to be doing well because of the war in Ukraine and the rise in price of oil, but it's the opposite. A well-known banker, the chairman of Health Holding, Tony Elumelu, said that he should know because he himself has invested heavily in oil production, crude oil production. He said that 80 to 90% of Nigerian crude does not get to the terminal. Think about this, you know, does not get to the terminal. So I hope people are hearing me because I'm not even seeing myself. Am I clear? Hello?
I think we're experiencing a little sound, the sound quality, Steve, it goes and comes. I see you have turned off your camera to increase the bandwidth.
Sorry.
So.
My camera is off.
We are not now hearing you if you are speaking.
Honourable Marlene,
Okay.
perhaps we can cut to Honourable Alejandro while we're waiting for Steve's connection to restart.
Are you hearing me now?
All right, Steve, if you go off again, then we will give you an opportunity to come back.
Okay,
right?
but are you hearing me now?
We are hearing you now.
Okay, so I was just saying that one of the major, even if we increase the benchmark, even if we reduce the oil production capacity of Nigeria, this will not solve the problem. The most important problem, like I said, about 80 to 90% of Nigerian crude does not get to the terminal for export because it's been stolen. It's been stolen. So even if at this point that we should have been experiencing growth in our revenue in terms of the war, because of the war in Ukraine, you know, we are moving even the benchmark to $73 from 62. Even if we increase that, it amounts to nothing because the oil is being stolen and because we've not been able to address corruption. if we cannot address corruption and if we cannot address the issue of oil theft, it then means that no matter how much oil we produce, we will not get results. We will keep borrowing. So one of the things that I would like to mention here is that even if, because we are borrowing, in fact, the federal government just submitted.
Honorable Steve, we'll just ask you to wrap in the interest of time. We do understand the concern about the crude not getting to the market, and we will pick up.
So I believe that there should be new policies. There should be guided policies. There should be effort by donor agencies, by the World Bank and the IMF to monitor loans that has been given to especially the developing countries, so that the money should be tied to projects, and those projects are monitored to be sure that it is being executed. So we have to look at transparency, corruption, leadership in these countries. So in submission for Nigeria, I believe that using the expertise of the IMF and the World Bank, there should be training of debt management office in Nigeria. There should be interface between the donor agencies, the lending agencies, the IMF, the World Bank, with parliamentarians in various countries for us to understand our role clearly.
Thank you so much.
And to give us some kind of to raise concrete issues and make sure that government is held accountable to the loan, because what is happening is now is that we are piling up
Honorable Steve.
loans for generations yet unborn. Thank you.
Holding the government to account, very important point. And how do we make good decisions when parliamentarians are prone to vote along party lines? We will come back to discussing the bigger points you have made. It is my pleasure at this time to welcome the Honorable Alejandro Cacase, Member of Parliament from Argentina. Thank you, Alejandro. Over to you.
Thank you, Marlene. Good morning to everyone. Yesterday, we had a very interesting session with the IMF Managing Director and the World Bank Group President. The topic was tackling inflation and tackling debt. Now we are concentrating on debt management and transparency. And probably the contribution I can make to the discussion from Argentina is showing how we face some of the problems that might resonate also elsewhere, and also show some of the good practices we've had in debt management and transparency. Argentina was facing problems with inflation and debt before the pandemic. We had inflation in 2 digits, and we had the largest standing loan with the IMF of about 45 billion USD. And as we've discussed already in this session, all countries, we've had the need to finance responses to COVID-19, and this has aggravated spending or aggravated the problem of public debt, as the poll question suggested, right? The high or the rising public debt because of the government spending due to the pandemic. And Argentina was no exception to that. The particular thing about our case is that we had no access to financial markets, so we couldn't finance spending through debt, but we actually had to directly print money from the central bank in order to increase our spending. And that turned out that we had in 2020 a fiscal deficit of 9% of the GDP. But given that it was done through printing money, this has brought now tremendous stress on our economy. Our inflation rate just last month in March was 6.7% in just that month. We are reaching rates of over 60% annually already. So this issue of tackling debt and tackling inflation, of course, is very important for us. But on the bright side, what I can say is that we've had a good experience in discussing this with full transparency. I heard what Carmen said before, which I thought it was very important, that we need full disclosure in times of high risk. The decisions that are taken today by public officials have a great impact on the different variables of the economy. And I believe we've done that in Argentina. All the debt restructuring with private creditors was discussed entirely in Congress. And recently, last month, we had to renegotiate with the IMF this standing loan we had, and we asked for an extended facility fund. And that was also discussed entirely in Congress. After we had an experience of 21 executive agreements done through history with the IMF, for the first time, the entire agreement with the IMF was discussed in Congress.
Wonderful.
We discussed the memorandum on economic and financial policies in Congress. We discussed the technical memorandum of understanding in Congress as well. So I think that despite the great difficulties we are facing in terms of inflation and debt, we can also contribute with that good practice we've had in Congress of having full disclosure, full transparency in discussion of public debt in Argentina. And I think that's an experience we can contribute to the rest of the parliamentarians here present. That's the message I wanted to convey, Marlene.
Good note on which to wrap your contribution, Alejandro. Bringing a full discussion to the Parliament makes good sense after your 21 executive agreement. We will now take the contribution from the Honorable Guillermo Centemero, Member of Parliament from Italy, and then we will go to our then we will discuss the poll results and go into question and answer. Guillermo, I regret to say that having come at the end, I'm going to ask you to be as succinct as possible so we can have some time for the Q&A. Thank you so much.
Sure, thank you, Marlene. Well, my name is Giulio, not Guillermo, but I will adapt to my new name anyway. Thank you for inviting the Parliamentary Assembly of the Mediterranean. I'm an MP from Italy, but of course I sit in the Parliamentary Assembly of the Mediterranean, which gathers all the country around this beautiful big lake, which we call sea, and which unite all of us. And in our region, and especially in the MENA region, we have witnessed to an increase of public debt of about 50% in average. Concerning my country, the pandemic posters up the public debt to about 130% of the GDP. We have access to the financial market, not like the previous speaker was saying concerning Argentina. So when you have access to financial markets, yes, you can increase debt because then you negotiate it. Therefore, some characteristics that are common to Mediterranean countries is that, well, we don't have specific agencies for public debt. For example, in Italy, the Ministry of Economy and Finance was united, and we don't have anymore a ministry that follows and studies and classify the public debt. This would be an action useful for all the countries and especially for our countries. Moreover, we come in a period after the credit crunch and the pandemic, two big black swans that were not forecastable. And then war came, which I would not classify, which I would not call a black swan, but also adapt on a period of big inflation. Therefore, in countries such as mine with high public debt, the fiscal space is reduced, and we have to think of policies in order to tackle this problem, which is the high public debt. As I was mentioning before, agencies concerning or ministries concerning the classification and the restructuring of the public debt would be useful. Also, in order to better plan the go-to-market for public debt in order to avoid short selling or phenomenon similar to the short selling. And then, of course, initiatives should be taken in order to increase growth, choosing some sectors of countries in order to invest in those sectors to have a real return on capital expenditures. Thank you for listening, and thank you again for inviting the Parliamentary Assembly of the Mediterranean in this forum.
Julio, see, I've gotten it right now.
Giulio, not Spanish, Italian.
Giulio.
Great.
Thank you so much, Giulio, for sharing Italy's experience with us. All right, so the poll results are in, distinguished ladies and gentlemen, and I see that 98% of respondents have expressed the concern for long-term growth, the rising public debt as a concern for long-term growth in your country. 98%. And of the 2%, it would be, I'm curious to know which economies are those, why there would be no concern about public debt. I have to say that in case of Jamaica, we have managed to come through the pandemic without a debt crisis. Really interesting case study. And the results for poll question number 2 also in, and we see 42% of respondents have indicated that we need a combination, all of the above, fiscal policies, monetary policies, other growth enhancing policies, oversight and anti-corruption measures as policies that should be given priority, taking precedence over others to mitigate the increasing debt levels. Very interesting, very interesting. No one combination, I think, will do the job. And so, you know, I think because so much power is vested in the executive, at some point, we parliamentarians will have to spend some time with the assistance of the IMF and the World Bank, how to better enable legislators in discharging their oversight responsibility. We have a number of questions that have been posed, and we're going to go into the first 4, and I will invite both Carmen and Jayla to help us navigate the responses, desired responses. So in the first round, question number 1 says, is there a major difference between developed and developing economies in managing debt post-COVID? And do you have any advice? That question is from Stephen Amau, Member of Parliament from Ghana. The second one, how can poor countries get debt forgiveness? That's Matthew Niashanu out of Zimbabwe asking. And number 3, what are the major and other unexpected factors that increased inflation? Is a country's debt calculated in relation to individual citizens' debt? Instead of private debt becoming public debt, can the private sector assist with taxes or accept elimination of government subsidies? And that's Senator Rosa Galvez from Canada. Carmen, you want to take first shot? You need to unmute your mic, Carmen.
So let me start with some of the differences in debt management between advanced and developing. I think there are 2 critical ones. One is, and it's not just post-COVID, it's the structure of the debt itself. For advanced economies, most of the debt for most of the advanced economies is overwhelmingly domestic currency debt. with hard currency debt being much, playing a much smaller role. This is very important. And this actually, so this is one point on the differences on debt management. So the issue of having to worry about currency risk, having to worry about currency mismatches is much less of an issue for that very reason. I mean, domestic debt has been growing very rapidly in many emerging markets during COVID. In particular, domestic debt was a big source of financing. But even then, in a number of countries, some of the domestic debt is also foreign currency debt. So the issue of currency is very important because, and this connects to the third question on inflation. I'm asked all the time, well, isn't rising inflation a solution for high levels of debt, public debt and private debt? The bottom line is yes, if, and very importantly, a very important if, the debt is, for starters, in domestic currency. Inflation can erode the value of the debt if it's in domestic currency. However, for most of the emerging world, the developing world, there is a combination of domestic currency debt and foreign exchange debt. And inflation doesn't really help much, because if it reduces domestic debt, which it may well, at the same time, it induces currency depreciation, because inflation and currency depreciation go hand in hand in particularly in emerging markets. And that means that the value of the external debt will increase. So the external debt, it may so bottom line, inflation may reduce the domestic debt burden, domestic currency debt burden, but the valuation effects on external debt can be very powerful in offsetting that. And the second part, and I'll be very quick because I'm not going to tackle all the answers, but the second part, a big difference, and I highlighted this in my remarks, it has to do with maturity. Debt management in advanced economies has, as a whole, tended to rely more on medium to long-term financing. This is not to say that we have not seen periods of shortening maturities and so on, but the yield curve that advanced economies typically face is much flatter than that for emerging markets. And so, and this is true, importantly, also for corporate debt. This is in regarding the third question, because for corporate debt, not just public sector debt, the tendency to borrow at shorter maturities is incentivized by a very steep yield curve, i.e. short-term rates are much lower. Borrowing short is much less costly in the short run than borrowing long. But let me reiterate the message. Times of high risk are times to avoid or reduce rollover risk. And one way to do that is, even if it is somewhat costlier to borrow longer maturities, it is the safer bet. On the issue of debt forgiveness, let me say something very quickly. The international community is not there at that stage. If you recall, the last experience or the last big debt crisis in emerging markets and the subsequent debt forgiveness, it took a long time. It took a very long time. The debt crisis of the 80s, especially for the smaller economies, began even before Mexico defaulted in August of 82. It began in 1980. We started to see defaults. The HIPC, Highly Indebted Poorest Country Initiative, wasn't introduced till 1996, and the actual HIPC debt reduction write-offs started later. Now, the Brady Plan did do write-offs for mostly middle-income countries. And this isn't grandiose debt forgiveness. It was a restructuring, and that it did involve write-offs in the early 1990s. But even there, we're talking about many years. And what I see, and Sheila made the point, the common framework, which was supposed to be the catalyst to move towards debt restructuring for countries like Zimbabwe, like Zambia, like Chad, countries that, you know, with an IMF program, with a macro framework, can move forward towards debt restructuring. The progress there has been it's been stalled. And so I would not be realistically suggesting here remotely that, you know, there are going to be efforts towards debt, you know, debt forgiveness, big debt write-offs around the corner. I'll stop by saying that, and Sheila mentioned this too, China is a hugely important largest official creditor. And so far their approach historically, and through their many restructurings with many developing countries, is not a restructuring approach that involves write-offs. It's an approach that mostly involves granting some you know, temporary grace periods and so on, but no write-offs. Let me stop there.
Thank you, Carmen. I think the question of the debt forgiveness is one that will recur from time to time, and perhaps at some point the international community will have to look at the lessons learned in terms of the pace, especially, you know, the HIPC write-offs, as you indicated. But I think it is a genuine concern, and I'd be interested in hearing at some future point what are the lessons learned from the approach taken so far. Sheila, may I invite you to weigh in?
Yeah, so on the question you just asked, actually the World Bank recently published a very good note paper on the lessons from earlier debt restructurings, HIPC and some others, and what that means going forward. And some of the issues that Carmen mentioned are very relevant in that context. I want to make two comments about what fully agree with Carmen, and the ability to be able to issue long-term debt in one's own currency, in local currency, really depends very much on the availability of domestic savings and domestic investors in particular. And that's when MP Alejandro mentioned the program with Argentina. A key component of it is actually capacity building and working very closely with the government in terms of developing domestic capital markets, how to make sure that the government can be transparent and have a program, a debt management program, that is able to tap into the savings from the domestic savers. It's also very important to be able to tap institutional investors. This is both domestic as well as international. And for those investors, of course, some of the risks Carmen mentioned, FX risks or regulatory risks or political risks, institutional capacity, all those are key issues that they have in mind in terms of allocating funding to emerging markets and developing economies. For many countries, international institutional investors, which sit on large piles of funding, are not are not accessible. So that goes to the reforms that were mentioned already. Inflation, of course, inflation surprises will lower debt to GDP ratios in the short term, but if you have persistent inflation and inflation volatility, ultimately this will raise the cost of borrowing and also impact the ability to issue longer term debt. So inflation can help if it's a surprise, short-lived, but if it becomes persistent and inflationary expectations are de-anchored, I think that will create problems even for some of the advanced economies. I also want to pick up one last point, which is in the questions that are coming up, and that's the importance of domestic revenue mobilization. Of course, debt and tapping into savings is important, but it's also important for many of the low-income emerging market countries. Revenues, fiscal revenues to GDP are very low, tax revenues are very low, and that really goes to this issue of making sure that countries are able to have accountable, transparent processes to be able to raise taxes and mobilize revenues domestically. That has to be part of the strategy for many countries. And in Jamaica, I think you have good lessons for that as well. We can't hear you, sir.
Thank you, Jayla. Jamaica is an interesting case study. Our public debt is a first call on our revenue. And for so long, we have not been able to do anything. Still not out of the woods, but we really have learned a lot. And the discipline that is required to ensure that we do not go down the path that we have taken is one that certainly my government is committed to, in spite of the outcry. Because when the needs are real, and you say to members of parliament that, you know, we can't do this project, because every decision we make today have implications down the road. But thank you so much. All right, let me go to the second round of questions. Out of Burundi, Nestor is asking, debt can stabilize the economy, and we are aware of this. However, access to development credit is not easy, especially for less developed countries. What are the measures put in place by the World Bank to access credit more easily? Then out of Senegal, we have Chiku Shasi. With a war between Russia and Ukraine worsening debts, how should African countries deal with the economic crisis and rising inflation? And then Yasser from Bahrain is asking, at a time of rising interest rates, would you suggest that countries borrow long-term and diversify borrowing to finance short-term budget deficits? So debt, stabilizing the economy, measures put in place by the World Bank. Over to you. I will. Jayla, you want to take the first shot?
Sure. I'm not going to talk about the development credit. I'm sure Carmen will talk about that issue. I will two comments from my side on the very good point raised by our Senegalese representative. It is very important that that we think very hard about African countries. Of course, as you know better than me, Africa is not homogeneous. It's very heterogeneous with different countries with different issues. And you mentioned also in the question about canceling debt. That I think, as Carmen mentioned, that the international community has to think very hard about whether we are at that point that whether we need a systemic response to the debt crisis, which would be an initiative that was used in the past, the HIPC, the MDRI, and so on and so forth, but we're not there yet. I think we are still, the DSSI, which was put in place by the G20, the debt service suspension initiative, which the IMF and the World Bank called for, was for liquidity constraints. It was to say, okay, let's suspend that service for a few years to give countries time to manage the pandemic, where there was also a lot of uncertainties about the pandemic. But then the G20 came up with the common framework. Basically, if it's not a liquidity problem and if it's a solvency problem, that has to be dealt with in the context of a debt treatment, part of which would include, on a case-by-case basis, writing off debt, which is canceling part of the debt. And I think that's why we have been pushing for the common framework to actually work. It has not so far delivered, but this would be a very important mechanism to be able to provide countries with the ability to put their debt in a sustainable level. On borrowing long-term, financing short-term budget deficit, I think that would create a lot of problems because I think the key, I mean, obviously it's very important to borrow long-term, true, especially at this time, as much as possible, it will be important to lower the cost of borrowing. But I think it needs to go to very carefully prioritized financing and to come back to the point I raised before, that it's growth enhancing as well as dealing with some of the scars from the pandemic. So social safety net, making sure that the vulnerable are protected, but that the revenues or the deficits are actually prioritized very carefully to not create another debt problem going forward.
Thank you, Jayla. Carmen?
So, you know, these are very difficult questions. We are living very difficult times. In an ideal world, of course, given the setbacks that we've been discussing both before COVID, during COVID, and now the new challenges through rising food prices, more supply shocks, and so on that countries are facing. In that ideal world, one would say, well, to foster recovery, to foster renewed impetus in reducing poverty, meeting the SDG goals, you would need both stimulative fiscal and monetary policy, you know, to add an impetus to the recovery. However, initial conditions matter a great deal, and we are very far from that ideal scenario. Fiscal space is limited, and that means also that the capacity to do stimulus will continue to face important constraints. Do you simply say, well, I can borrow, I can try to go to, you know, an IMF program, I can get, you know, funding from the World Bank, the multilaterals, what, you know, try to the official sector. In the end, debt is debt. You know, and the time comes where you have to repay. And so this goes importantly also to what Jayla was saying, usage, how growth enhancing. What was the debt used for? I mean, the idea that one can borrow and continue to borrow to fund current expenditures without any sense whether those expenditures will have a really good footprint on growth is, you know, basically a Ponzi scheme, bluntly put, you know. And the idea that, well, look, if I can't really borrow internationally or it's too expensive to borrow internationally, I borrow domestically. Well, most developing countries, especially low-income countries, have limited domestic capital markets and capacity to absorb a lot of debt. So that becomes really inflation financing. It stops being domestic debt financing and it becomes inflation financing. Inflation is the most regressive form of tax that you can possibly imagine. I want to highlight that point because this also goes back to something Sheila had mentioned, which is governments really need to look at revenue enhancement and widening the revenue base. And, you know, exceptionally low levels of revenue, i.e. single digits, where revenues as a percent of GDP and in single digits is very much not just a short-term problem, but it's a medium and long-term problem that really inhibits the capacity of many governments to really plan intertemporally, whether it's investment or any kind of long-term planning. So revenue bases need to be built because the idea that, well, we can do this through inflationary finance, be very careful because, you know, turning it on is easier than turning it off. And it is a very regressive tax. The wealthier realms of society have much more capacity to hedge inflation risk than a wage earner. And especially in an environment like we're living through today, where a lot of the inflation is importantly also associated with a big hike in the relative price of necessities, food and energy. That really hits the poorest segments within the economy, as well as across economies, especially hard. So, you know, I don't envy policymakers. I think we are going to see continued challenges of delayed recovery. I think, you know, the revenue enhancement has to be a very, very important point, a very important goal in that agenda now. So to enable to provide better services. You don't solve debt problems by borrowing more. As I said, I don't think the international community is at a point in time yet where they have come together to say, we're gonna move forward with an ambitious program of debt write-offs.
Thank you so much, Carmen. We really do not solve the debt problems by borrowing more. A major lesson that Jamaica is learning, you know, for the road we have taken. We're now into the very last segment of the session. I'm going to pose the last two questions and will, as you respond, Carmen and Jayla, also invite you to make your closing remarks. I know you have to run soon. And then I will also ask our distinguished MP panel to weigh in, Alejandro, Julio, and Steve, in that order before I make my closing remarks. So here we go. Our own chairman of the board, Liam Byrne. Liam, you really shouldn't get a go at the questions, but it's a good one. Could the World Bank and IMF help the parliamentary network prepare a note to share with the legislators on the G20 common framework? That's from our chairman, Liam Byrne, Member of Parliament of the United Kingdom. And out of Bahrain, we had Reda Faraj asking, COVID-19 uncovered considerable weaknesses in areas such as education, health, and infrastructure, necessitating additional spending for emerging and developing countries and leading to increased borrowing and debt. Addressing COVID pushed other growth projects behind, making the SDGs impossible to achieve. How can the World Bank and IMF help emerging and developing countries realize these goals? All right, Jayla.
Thank you, and I responded also on the chat. Very happy to help the parliamentary network with a note on the common framework. We would be very happy to contribute and support. I think this would be extremely helpful for the world if there was more voices really pushing for the implementation of the common framework. That's what we have right now. We don't have anything else. So we need to really make it work. And it worries me a lot because we are in these very surreal and uncertain times. We don't know what's going to hit us next time. We have been crisis after crisis. And for countries that are indebted, our hands are tied. We as the international community cannot lend to a country because our membership, our policies dictate that if debt is not sustainable, we are not able to support that country financially. So we really need this, and I'll use this as my closing remark, and also on this very important question that was raised about the need for financing for the Sustainable Development Goals and the scarring from the pandemic and the need to recover better from the pandemic. There's a huge divergence which will create social tensions domestically, but also internationally. So it's very important that the international community comes together to support countries, both by international support. Yes, the IMF can do whatever it can with our tools, including our new tools, the Resilience and Sustainability Trust and so on. But official money is not going to solve the problem. The needs are too large. We need bilateral donors, grant money. We need also the private sector to come in. And the private sector will only come in if the countries continue with the reforms in terms of strengthening their institutional capacity and showing that the returns to the investment, the private sector is not a charity. They will come if the returns to their investment are high. And many countries, that returns are actually very high if the governments actually manage countries well and take the right policies and issue good debt, which enhances growth. Thank you very much. It was really a pleasure to participate in the discussion.
Thank you so much, Jayla. We certainly enjoyed having you and the wisdom you have shared with us. Over to you, Carmen.
So, well, it's been a real pleasure, and I hope that you know, the very difficult issues being discussed here are you know, have been of use. I think there was a couple of points that I would like to make. One is that the very important issue that the setbacks. I've recently written a piece. I encourage. It's a World Bank blog. Please look at it, called "The Reversal Problem," which deals precisely with the issue raised on the setbacks to many of the development goals in education, in infrastructure, in almost every facet, per capita incomes, the setback of the last few years, even before COVID. What can an institution like the World Bank or MDBs do? Well, the World Bank is, an institution that it tries to target development, and its lending is long-term and can be earmarked. In principle, at least, to fulfill some of these goals, it can be, targeted lending to support, secondary education or particular health programs, or particular infrastructure projects. But money is fungible. in the end. And, you know, so how do you deal with also the country's decisions that, you know, ideally this funding was meant to be for these targeted goals, but instead it goes into debt repayment, repaying high yield debt of the corporate sector or other official creditors. That is also a government decision, and it's a very difficult one. It's a very difficult one. I'm not belittling it, but I'm saying that the idea that, and I made this point, that in a debt crisis, borrowing borrowing more is, you know, not the most obvious solution. Let me put it this way. I do think that the issue that Sheila mentioned at the end, which I had neglected to mention, I had focused on the lack of movement forward or the lack of momentum in debt restructuring as, you know, primarily an official sector problem. But the private sector, I mean, we saw this during the lack of participation during the DSSI. The lack of participation has to be brought on board. And, you know, I have with colleagues written also a short piece on why debt restructuring gets delayed. And this also goes back to what Sheila mentioned, that there are factors associated with creditors not wanting to take a haircut, and there are factors associated with debtors that can't get their house in order, and therefore are not able to deliver a program that generates the kind of trust to see the debt going forward as sustainable and to restore their repayment capacity. So it takes both. But, you know, again, I would not, thinking about what the international community is going to come in and write off debts, that's not a plan. That's a hope. And right now, the G20 is very fragmented. As you know, after the Russia's invasion of the Ukraine, very fragmented, which also adds another layer of complication to how fast the common framework, which is a child of the G20, will move forward. Let me stop there. So the idea, my parting message was very much also look domestically for revenue and for growth enhancing, and again, balancing those trade-offs, whether the limited resources are put to, you know, try to fulfill certain
Thank you so much,
you know, development goals or not.
Thank you so much for taking the time to share with us. We look forward to reading your two pieces, the reversal problem and why debt structuring gets delayed. It has certainly been our pleasure. Distinguished ladies and gentlemen, we're literally down to the wire. I'm going to invite Alejandro and Julio, in that order, literally 30 seconds for your closing sentence.
Yeah, well, very briefly, we've had comments from two experts from the World Bank and the IMF. They've made very interesting remarks. Also, in the poll question number 2, you asked the parliamentarians, do we need fiscal policy? Do we need monetary policy? Do we need growth? And the answer was all of the above. We need all of that. I think the reply is in finding a particular combination of monetary and fiscal policy that works for each country, taking into consideration also that we need to tackle inflation and debt without compromising the recovery that countries are having after the pandemic. So that's a particular combination for each country to take. As Carmen said, the answer can be to get out of debt by borrowing more.
Thank you, Alejandro.
We need particular responses in each country. Thanks.
Thank you so much. Julio?
Thank you. I will not add anything to the previous responses. I just invite all of you to the Mediterranean Economic Forum, which the PAM will organize over the fall in Morocco. So see you everybody in Morocco.
Thank you so much. I think Steve is away from his desk. Just to say what an engaging session it has been. You know, after gaining independence in 1962, Jamaica enjoyed strong economic growth and achieved middle income status quickly. 3 decades later, income started to plateau, including following a massive financial crisis in the 90s and further setback in 2008, global financial crisis. Challenges have ranged from policy missteps that led to high public debt, to vulnerability, to natural disasters. Emigration, brain drain, high crime. By 2013, Jamaica's public debt had reached a historic high of about 147% of GDP, making it one of the most indebted countries in the world. After a debt exchange in 2010, yet another IMF-supported program that went off track. In 2011, the country was on the verge of an economic meltdown with no access to international capital markets. Jamaica once again turned to the IMF in spring 2013 for financial support. With its preceding weak track record of reforms, significant budget financing from international and development partners was less forthcoming. Jamaica needed a second debt exchange and a primary surplus of 7.5% of GDP to help stabilize the economy and address long-standing structural climate. Talk about delivering program with credibility. The public said enough is enough. You know what? The government has not done a good job. So the Economic Program Oversight Committee, EPOC, was formed so that stakeholders from the private sector, unions, government, academia, and the media could come together to hold the government of Jamaica accountable for its reform commitments and fiscal discipline under the reform program. And, you know, just jumping forward, I invite you to look at our country report. We really are a case that is worth looking at. Today, we are doing what is required to hold strain, to ensure that our borrowing does not put us off rail, so that when the real needs arise, we can deliver better to the people. Thank you so much for joining us in this session. I invite all parliamentarians to pay attention to the information put out from time to time by the World Bank, IMF, and do stay tuned for all of the parliamentary networks program of activities over the next year and a half. It has been my pleasure serving as your moderator, and let me thank the hardworking team behind the scene led by Gorgana and her team at the Secretariat, and also Sholto. Thank you so much for helping to keep the session on track. Good morning, good afternoon, good evening, good night, ladies and gentlemen. Thank you all, especially our speakers and panelists.